Good afternoon, everyone. Mike Smela, excuse me, Mike Smela, financial educator and advocate and founder of NFI Hunters Inc. We're going to look today at a really kind of interesting and fun little exercise that really goes to show the differences between what we've always been taught about focusing on rates of return on our money in investments versus what truly is important, which is the growth or loss of our money. Now, what we're going to look at is we've got four people who each are investing $100,000 for 4 years. And this is kind of a bet for the four of them, because what they want to do is they want to say, look, we're going to invest in different vehicles. And at the end of 4 years, whoever ends up with the most amount of money is going to take home all the money. Okay. So again, what we are really taught to focus on within our financial world is of building a foundation of investing, or what really truly is risking our money in, quote, the market, in the stock market. Again, we want to, hopefully you'll start to realize some potential cracks in a foundation that is built on risk. Okay, so let's just dive right into this here. Investor number one, in their 4 years, they have looked at and said, okay, here, we invested for 4 years and here's what their actual returns were. It went up 10% the first year, went down 10% the second, went up 10%, went down 10%. So over the course of those 4 years, this investor's average rate of return was 0%, right? That's exactly how it works. You see what happens in the number of years that you invested, add them all up, divide it by the number of years that you've invested, and that is your average rate of return. Investor number two had a real, although not sensational, 4% growth each year in the investment vehicle that they invested in. Okay, so again, it's 16, 4 plus 4 plus 4 plus 4 is 16 divided by 4% average rate of return. Now, this also represents true what is called linear or compounding effect of money, because you can see that it was 4% all 4 years. The third investor, well, they went on a roller coaster ride here. But it's really not uncommon, especially if you were around in 2008, 2009. So they started with $100,000 and in year one, it dropped 50%. But what is it that we've always been taught? Invest for the long term. The market will always recapture its losses over the course of 100 years or 80 years or whatever. The market, although it's had ups and downs, will continually go up. And what happened in this situation is exactly that. Yes, it lost money the first year, but in years 2 and 3, it recaptured those losses. The investment did. And then in year number 4, it actually went up 40%. So this investor actually saw an average rate of return of 10%. And investor number 4 went on a real roller coaster ride. His investment went up hugely the first year, but then year number 2 didn't do so good. Year number 3 bounced back tremendously, and year number 4, it dropped back down. But over the course of those 4 years, if you add all up, 100 and 100 is 200, minus 50 is 100, divided by 4 is an average rate of return of 25%. Okay, so based off of this, all 4 of these folks get together at the end of the 4 years, and who do you think's the winner? Well, again, you would think that the person that had the 25% average rate of return is the one that's going to walk away with all the money, right? Well, again, what we need to realize is that what is truly important with everything is not average rates of return, although that's what we've been taught to focus on. What is truly important is the growth or loss of our money. See, they all started with the same amount, the $100,000. And now let's take a look and see when they open up their envelope. Investor number 1, his went up 10, went down 10, went up 10, went down 10. So he started with 100, had a 0% average rate of return. How much that person ought to have? Well, that person ought to have $100,000, right? With a 0 rate of return, they ought to have $100,000. It makes sense, whatever. So they open up their envelope, and lo and behold, it's only $98,010. Well, why is that? Well, you see, what happens is this. is in year number one, it went up 10%. So he had $110,000. Year number two, it lost 10%. It lost the 10% from the 110. So when he started at year number three, it wasn't from the 100,000. It was actually from 99,000 or whatever it is. Okay. So as you see with this, even though they had a 0% average rate of return, they actually lost money. So there isn't a correlation between the rate of return and the actual dollars that are in their pocket. Let's take a look at investor number two. Investor number two, you would think with a 16 or with a 4% average rate of return over 4 years, they ought to have $116,000, right? Well, no. What you can see in this situation is that, again, the average rate of return does not correlate to the growth or loss of the money. Because in this case, they actually, because of compounding, true compounding, they actually ended up making more money than their average rate of return. So the average rate of return still wasn't a true indicator of how much money that they had. Investor number three, again, lost 50% in the first year, but then recaptured, or the investment recouped its losses. And in year number four, they had a 40% gain. So they had 3 years that were tremendous growth to offset one bad year. So they had a 10% rate of return. They ought to have what, $110,000, right? At least. So when we look at the envelope, it's actually only $109,200. Why? Because in year number two, they didn't start with 100,000. Again, they lost 50% year number one. So their starting point was $50,000 year number two. So even though it went up, and went up, they still only averaged a 9.2% rate or growth on their money, even though the prospectus can legally say that they had a 10% average rate of return. And number four went up 100, went down 50, went up 100, went down 50. They had a 25% average rate of return. You think they're not bragging about things? Well, again, they started with 100. How much did they end up with? The same $100,000. Well, how can that be? Well, again, folks, let's go ahead and see. Let's follow the money, which is the real important thing. They started with 100,000. If it goes up 100%, how much do they have? $200,000. If it goes down 50%, 50% of 200,000 is what? 100 or 100,000. Goes up 100, goes down 50. They started with 100. They ended with 100. What was their average rate of return? What could that be? It a mutual fund, be it a stock, be it whatever it is, can legally show that they received, or they created, a 25% average rate of return over those 4 years. Because why? Because they did. But again, folks, what we need to realize is that what is really important is the growth of our money or the loss of our money, not the average rates of return. There is no correlation to that. And it's real interesting. So I've got a good friend of mine, Dwayne Burnell, wrote a couple of great books. And Burnell's law says this: math is math, money is money. But what we need to realize is math is not money. We've been taught to focus on risking our money, which, again, who is at risk? We are. How much? 100%. Who has the control of our money? Not us. So we give up control. We assume all the risk. And when we plug things into financial calculators, these financial calculators are primarily based off of compounding effect of money. If you put $500 a month in starting at age 30 and the market grows at 4%, 5%, 6%, whatever, or averages that over the course of history, or over the course of the next 30 years, you're going to end up with $1 million, $2 million. Wow, sounds great. Sounds wonderful, doesn't it? However, and even during those 30 years, you may have a 5, 6, 7, 8% average rate of return. The challenge is average rate of return is not compound growth. If you want compound growth, you need to put it into vehicles that create true compounding. And folks, that is not, if you're, again, creating a foundation, if you are basing your long-term financial stability and financial health on vehicles that can lose money, you will never see compounding growth. So again, we need to start to realize different things and focus on what is truly important, which is the growth or loss of our money. Okay. So hopefully this little exercise starts to open your mind that, again, guys, math is math, money is money, math is not money. You need to focus on what's truly important and get answers to your questions. So one of the things that we talk about with our clients is what we call as financial foundations 1, 2, 3, 4. The first thing about this is we need to realize that we need to have very much empowered thinking and empowered feelings about money. So we need to be motivated, and we need to realize that we truly can have a very different future with our money and a very different outcome with our money, but we've got to start thinking about it differently. We've got to be able to realize that we can be in control. Second thing is we need to leverage different information. Okay, now this information isn't necessarily new. In fact, it's been around for hundreds, if not thousands of years. It's just that only a few ultra wealthy families, ultra wealthy individuals, corporations, banks have learned and leveraged this information. It's not taught to us as the masses for very specific reasons, but we need to leverage this different information. So you need to be motivated. You need to be educated. But one of the things that I've learned in my years is that there are an awful lot of very highly educated and very highly motivated individuals in our country. And there seems to be a huge disconnect when it comes to money because these highly educated and highly motivated people still are not achieving what they want financially. And that is because, number three, we need to leverage and utilize different and better vehicles. Okay. You can be as motivated as possible. You can be as educated as possible. But if you get into the wrong vehicle, if you put your hopes on the wrong vehicle, that may or may not get you to where you want to get to. If it doesn't get you to where you want to get to, it doesn't matter how educated you are or how motivated you are. You need the right vehicles in order to drive your motivation and your knowledge base. So this is a huge disconnect. And fortunately, when you're able to put all three of those together, the great part about it is you truly can receive and enjoy lifetime results that will work for you regardless of the economy, regardless of what happens in the roller coaster markets, because you are in vehicles and strategies that are specifically and fundamentally designed for you to benefit regardless of what happens in the economy. And that is a very, very different thought process. But as I can attest to, and as clients can attest to, it creates a tremendous results. And ultimately, folks, results when it comes to money is the only thing that matters. Okay. So if there is anything that I can do to help, please feel free to reach out. Again, our goal is truly, as it says on the bottom, helping individuals, medical and business professionals create and enjoy a lifetime of financial success and empowerment. We will see you on our next video again. And so have a great day, and we'll talk to you soon.